Good day, entrepreneurs. Previous recording, I had spoken to you about 4 types of accountants. I call them 4 sisters. Sister number 1, financial accountant. Someone like me who's a chartered accountant or other professional bodies that sign off on the financial statements. CIPA also does, CYBA also does. Number 2, tax accountant. That is the accountant that looks at the legislation. I also spoke about cost accountant, which is the accountant that look at the costing on how you have costed your products and services. But the last one that was also mentioned was the management accountant. So today we're going to cover the role of the management accountant, but we'll also map out step by step how to set up your management accounts, aligning them to your key performance indicators based on what you have done on strategy. When you are setting up a strategy, you need to be very clear of what is your baseline, i.e., where are you right now? Because like any GPS, before you can press start to direct you to go where you need to go, you first have to know the current location. So once you have established that, you then have to identify what will be the key performance indicators within your finances. And again, as we go through step by step, I will show you the simplest way of approaching this, but also over a period of time, how can you add more complexity to it so that it's enabling you to actually make the right decision. Management accounts are very important because that is what we use as managers to manage the organization. But it also helps us to watch out for the things that we know drive our business output, but also the things that we measure. You can take the key performance indicators at the organization level, then also later assign them to individual divisions. After that, assign them to functional, and then assign them to individuals. Performance agreements of your staff and the people that you work with can also be set according to those key performance indicators. I hope then you will understand that when you go on the board and explaining the principles, you're going to see step by step on how to set up the management accounts that will help you to manage things that really matter in your business. Entrepreneurs, today we're looking at management accounts as I had said earlier. I am going to show you on the board the step by step on what are the things that you need to actually do to design your management accounts, but also be able to review and analyze your management accounts and monitor to be able to meet your goals. I think I also need to just expand a little bit. What's the purpose of management accounts? The purpose of management accounts is to help you as a manager to manage your books, to manage your performance based on what you have set up. Therefore, the step 1 in building up or designing management accounts, you have to set up a goal. You have to set up a goal, and that goal must have a specific target. And that target must be what you use to measure. Let's make an example. If step 1 is setting up a goal, and in that goal, you're gonna need to have a target. Now, because we're dealing with finances, remember in finances, we only deal with 4 things. Same principle apply. So maybe let's have this here. Remember that quadrant of 4 things. We have income here, we have expenditure here, we have asset here, and we have debt here. So if you're gonna set up a management accounts, and I am saying we're gonna need to set up a goal, the goals will be around these 4 things. And in the previous sessions, I had said when we were discussing understanding of financial statements, you always need to keep these items here higher. And then you keep these ones low. So if that's the case, then when you are setting up your target, you're gonna need to say the first one will be increase revenue. Goal number 2, possible, would say to increase the asset. Goal number 3 maybe may say reduce expenditure. Goal number 4 may actually say reducing the debt. So it doesn't matter. Any of these goals, based on where you are and what you want to achieve, can then be mapped in. So what is your goal? And I've just outlined possibilities of the goals. But then, once you have set the goal, the next step is to say, if I've said that I want to have a 5 million revenue, for example, I need to also know what is the current. Maybe the current is sitting at 1 million, which means if you're going to need to increase, you're going to go 4 million more than before. You then say, this is my target, this is my current. It's almost like you now have a baseline. Step number 2, you will then say, okay, how do I intend to achieve this? That then now talks to strategy. Now, one of the facilitators have covered the strategy already. A strategy is a clear plan on how you're going to achieve your goal. A strategy is a plan. So, what is your strategy to achieve your goal? You will then map that strategy, and number 2, 3, you will work out what is the milestone. Milestones are basically how would you measure as you are achieving or working towards your goal. So in your management accounts, you will then set up the target being 5 million in your either your budget or your projections, as 5 on your sales projections, but you then have a strategy which is a plan. And please, entrepreneurs, make sure when you set up in your plan should be on daily, weekly, monthly, and also annual. Make sure that you focus on daily, having a specific routine and activities that you are doing towards executing towards that goal. And then the milestone is what you're going to break down. Maybe you're going to say quarter 1, quarter 2, quarter 3, and quarter 4. So a milestone can be set according to a period or a timeline. As you then have set this up, you will then map your management accounts. We have said here, we're talking about revenue. So in your monthly management accounts, you know that on quarter 1 is 3 months. This is month number 6, 9, that is 12. So you will then say 5 million for the 3 months, and you might decide, you know what, I will just divide it by 12 months, that 5 million, then month so and so, 1 month number 2, month number 3. I don't like that approach because in most instances you find that your graph in the business is not necessarily this straight. It usually digs up like this. But the reason why it digs up like this is because of the trends. So I will suggest that rather still use the quarterly, but when you are setting up your sales projection, build them up on products and also build them up on customers, like I had said, especially when you're talking about sales, because that will then help you to know and see, is that customer helping me to achieve the turnover I was looking for, or should I maybe move on to somebody else? But also, is the product able to move, or am I actually selling something that is not moving? Either or, you will still make sure that as you are executing your strategy, you are monitoring. So your management accounts is broken down according to what? Your key performance indicator. And in this, your key performance indicator is revenue. It's the sales. That's your key performance indicator. And on here, you can measure by amount or you can measure by quantity or both, which is value. Remember, revenue is sales equal to quantity multiplied by price. So you can measure your management accounts by quantity. You can also measure by price, as long as it gives you the turnover that you are looking for. So that is how you can set up your management accounts. And in this case, we've just done one for the sales. You will then have to do the same thing when it comes to asset. Remember, under asset, when we were discussing the understanding of financial statements, we articulated that asset has a different categories. There's current asset, there's a fixed asset, and there's also investment that is an asset. You need to make sure that when you are setting up your goal, you are specific on saying, am I setting up the property, plant and equipment, or am I setting up the fixed asset, or am I setting up the current asset? Or am I setting up the investment? Either or, it doesn't matter, because when you set it up, you will then say, for property and plant in CapEx, I will acquire this much. We have already done that on a budget. So when you're doing the current asset, maybe you will say, I would like to have this much stock in my business by this time. I would like to have this much bank balance. So you're gonna then set them up that way. Again, you have to work and play with these four things. Break them down into pieces for you to be able to set your key performance indicators. The key performance indicators for asset will be the value of the asset or the number of cars. So it can be either quantity or it can be in value. And same principle, maybe you have said, I want to raise funding, more financing, which is your debt, more funding on my business. You will measure that by the amount of the deal that you are bringing in. You will not necessarily measure it by the number of agreements that have been signed. Now, when you have set this, you then plug it into your charts of accounts. The charts of accounts are those numbers or the list of different accounts that are on your financial statements in your book, which the accountants also will be part of the general ledger or a trial balance. When you plug those in there, you are then able to monitor these things on monthly basis so that you can see how far you are to the target, whichever target that you will have set in your business. At the end of the period, the management accounts can also be used to manage the performance, to manage the positioning of the business. Because at the end of the day, this item, remember, this side is a performance, this side is a positioning. So as you're building up your business, your objective is to increase the revenue, increase the asset, and reduce the expenditure, and reduce also the debt. But you then take this and build it up on your management accounts with specific milestone and with a clear strategic plan that is rooted on daily habits, weekly, monthly, and annual. And you can have quarterly also, as I had articulated in here. I hope you understand those basic principles that you actually have picked up on how to set up your management accounts. The management accounts are as good as your books. Garbage in, garbage out. So you're gonna need to make sure that your source documents are kept up to date. Things are being captured on time. The budget has been captured as we had discussed the budget previously, so that you can monitor the actual versus the budget and analyze the variances. And when you have analyzed the variances, do the necessary adjustment to fix the problem where it is required. Or in other instances, relook at the whole plan so that it's aligned to what the activities are. Remember, the management accounts are there to help you to monitor the performance of the organization. If you do not monitor the performance, you're almost like a student who goes to school and is only just going to wait for the report at the end of the year. There is no test that the student is doing, there is no progress, so there is no milestone. You have to have those milestones because they are telling you, are you in the right direction or in a different direction than you initially planned. Remember, things always change. You're going to need to adapt and amend and update how you actually have set up your planning activities. Those planning activities are influenced by the environment, and we all know the environment changes all the time. So that is why it's important to constantly monitor, set up the management accounts according to your key performance indicators, and be very clear what you intend to achieve, and build up those activities and make sure the activities are really embedded on the routine, on your habits, on how you are managing your organization. I hope you have learned, and we will send through some quizzes to assess if you understand this principle. And I also hope you're going to really look very hard on how you can take the financial management accounts and build up your own management accounts so that you can really run a business that you know what is going on. When you're analyzing financial statements, it shouldn't be too different to a point that you actually now are not even aware where those figures are coming from.